You already watched private equity buy the hospitals and let them die. So here's the part nobody's talking about, where that exact same firm went next. In the next few minutes, I'll show you how one Wall Street firm took control of an American battery company for pennies a share using your tax dollars to cover the risk, and why it's a template for the entire energy grid. This isn't a rumor, it's in an SEC filing dated August 6th. 20 million shares, one firm, and in the loan documents underneath it. This is how it actually works. August 6th, 2026. Buried at the bottom of a routine SEC report, one line, Cerberus, 20,017,772 shares of Eos Energy Enterprises. If that name rings a bell, it should. Cerberus Capital Management is the same private equity giant that owned Steward Health Care, the hospital chain that went bankrupt while the people running it walked away rich. Now they're buying a battery company, and most people read that headline and think, good, Wall Street is finally funding clean energy. That's the trap, because Cerberus didn't buy 20 million shares on the open market like you or I would. They exercised warrants, a right they had already locked in for a fraction of a penny each. To understand why that matters, you have to see the machine they built first. To buy something cheap, you need the seller desperate. In 2023, Eos Energy was exactly that. Eos makes a genuinely interesting product, a zinc-based grid battery. Water-based, non-flammable, no lithium, no critical minerals, built in Turtle Creek, Pennsylvania. On paper, a piece of America's energy future. On the balance sheet, a disaster. Eos had carried a formal going concern warning since 2022, accountant language for, this company might not survive the year. In its 2024 annual report, Eos booked a net loss of roughly $686 million on about $15 million of revenue. Read that again. It lost $45 for every $1 it sold. The stock told the same story, swinging from around $3 to nearly $20 and right back down to $3. A company with real technology, real backlog, and no way to fund its own survival. When a company is drowning like that, the rescuer doesn't have to be generous. They get to write the terms, and Cerberus wrote them beautifully. For Cerberus. Here's how the deal was sold. June 2023. Cerberus makes a strategic investment of up to $315.5 million in Eos. Sounds like someone writing a check for $350 million, right? Look closer. That $315 million is not a gift, and it's barely an investment. It's a loan. A $210 million term loan plus a $105 million revolving credit line. And the term loan doesn't arrive all at once. It's paid out in 4 pieces, each one released only when Eos hits a milestone Cerberus gets to define. Translation: Cerberus controls the oxygen supply. Miss a target, the next payment doesn't come. The interest? It started at 15%. For a company already losing money, that's not a lifeline. That's a leash. Later, after Eos prepaid $50 million, the rate dropped to 7% and some penalties were waived, but only after Cerberus was already senior, secured, and first in line to be paid. They even used the deal to clear the old lender out of the way, settling Eos's previous $100 million senior loan for about $27 million. The old creditor, gone. Cerberus, installed at the top of the stack. That's step 1, become the debt. Step 2 is where the ownership comes in, for pennies. Now the part that makes this a takeover, not a loan. In exchange for the financing, Eos didn't just promise to pay interest. It handed Cerberus penny warrants and convertible preferred stock, the right to own big chunks of the company for essentially nothing. How big? At signing, enough to reach 33% of Eos. And if the milestones are met, the same milestones Cerberus controls, that climbs to 49%. Just under half the company, for pennies a share, while your money funds the milestones that trigger it. Fast forward to that August 6th filing. Cerberus already held about 32.6%, roughly 176 million shares. Then they exercised warrants for those 20 million more. That's the extra 5%, pushing them to nearly 38% of the entire company. One filing, no open market buying, no premium paid. So the 20 million shares headline isn't Cerberus betting on Eos, it's Cerberus collecting, converting rights it was granted for pennies into real ownership, on its way to the 49% cap. The battery company didn't get a new investor, it got quietly absorbed. Here's the part that should make you sit up. Who's funding the factory that makes all those milestones possible? You are. In 2023, the U.S. Department of Energy conditionally offered Eos a loan guarantee of up to $398 million. It closed in December 2024 as a $303.5 million federal guarantee for the Turtle Creek plant. Taxpayer money backstopping the debt at Treasury rates out to 2034. Put the pieces on one table. Public money de-risks the factory. Cerberus's private loan sits senior to almost everyone, meaning if Eos goes bankrupt, Cerberus gets paid before ordinary shareholders see a cent. And Cerberus's penny warrants capture the upside if Eos flies. That's the whole game. Heads, the company succeeds, and Cerberus owns up to half of it, bought for pennies, on a taxpayer-funded runway. Tails, the company fails, and Cerberus is the senior secured creditor, first to grab whatever's left. There is almost no version of this where the firm that broke the hospitals loses. And remember what Cerberus actually is. About $70 billion under management. And its biggest platform isn't private equity. It's credit. Lending. This is what they do. Eos isn't a green energy bet. It's a credit play wearing a battery costume. So let's answer the question we opened with. Why did Cerberus buy 20 million shares of a battery company on August 6th? Because they weren't buying, they were converting, pulling penny warrants into hard shares, moving from about a third of Eos to nearly 38%, with a contract that lets them reach 49%. They are now both the company's largest owner and its senior lender. Whatever happens to Eos, Cerberus decides how it ends. Is that a rescue or a takeover? Honestly, it's both. Eos genuinely might not have survived without the money, and the plant, the jobs, the batteries are real. But saved and owned turned out to be the same sentence. The people who needed the rescue paid for it twice, once in ownership handed over for pennies, and once as taxpayers guaranteeing the loan. And here's the part to actually watch. This exact structure, federal loan guarantee on the bottom, private credit senior in the middle, penny warrants capturing the top, is the template. The energy transition is going to need trillions in financing. Firms like Cerberus have quietly figured out how to sit at the center of that money, with the public absorbing the downside. You were told Wall Street was finally funding clean energy. What actually happened is Wall Street found a way to own it, cheap, senior, and guaranteed. Now that you can see the machine, you'll spot it everywhere. Same firm, same playbook, next industry.